The title of Lesson 9 is High-FX Swing Trader 1.0. High-FX Swing Trader 1.0. According to Mark Douglas, in his book titled Trading in the Zone, he said, professional traders have gotten an edge. Most importantly, they trust their edge. Swing Trader 1.0 is an edge developed by Integrated FX Solution to identify buying and selling opportunities in currency market. It's a proprietary trading method developed by Integrated FX Solution. This method incorporates everything that has been taught from lesson 1 to lesson 8. So we are adding everything, all the components put together to form a formidable and reliable trading edge known as IFS Swing Trader 1.0. Introduction. One of the most profitable old-school methods in trading was buying when there is surplus. At this point, there are limited and price is very cheap. At that point, needs are limited and price is cheap. Then, when there is scarcity, when demand is high, when demand is higher than supply, will sell at high rate. So the markup is the profit. That has been the old school approach to trading. This approach has proved to be profitable since the dark age of trading by barter and still very relevant, and also the reason for profitability in these contemporary days. That is, buy low, sell high. Buy low, sell high. Wisdom say you buy when it's cheap and you sell when it's expensive. Buy low, sell high. Our method to trading is based on this old school approach where we determine strength and buy cheap, that is buying low, and determine weakness and sell at high rate, that is selling high. The merits of the method. This method have the following advantages as stated below. 1. Low operational cost. Trading is a business and we treat it as one. For every aspiring trader, for every trader that is aspiring to be successful, we advise that it take trading as a business. So in every business, there is what we call operational cost, though it's different from country to countries or across region. But then the most two vital operational costs in trading efforts are costs of power and internet. This method conserves the use of power and internet as the average running time is not more than 3 hours daily. That is amazing. 3 hours. Imagining spending 3 hours for trading and achieving so much. That is awesome, and that is the power of leverage. Using little to achieve much. In every business, if the power of leverage is ignored, most likely the business will not do well. So in FX as trading, we incorporate what is called power of leverage. 2. Due to the few hours spent in daily time in doing the analysis and placing the trade, it creates room for alternative income generation. Because of the limited time spent in executing trade, it gives room for doing some other things. If you are trading this method, I will not advise, or this method will not hinder your day job. You shouldn't resign from your day job. This method will give room for you to do some other things. If you are doing businesses, this method will create room for you to do other businesses. This is amazing. You spend little time and you achieve so much. It is tested and trusted. The approach is premised on a concept that has been in trading right from the inception, and the same concept is still profitable. It reduces fear and greed. Wow! Ask traders, the major killer in FX, and they'll tell you is fear and greed. Many people are afraid to pull the trigger because most of the system out there are not systematic. Okay, but in this method, right from the time you know when to get in and when to get out. Once you know when to get in and when to get out, it reduces fear in executing trade. Even we know that the market is dynamic. When the market changes, when at times the market, it does changes, the method allows room for flexibility to adjust as the market dynamics changes. It's an awesome trading method, powerful, reliable, and excellent. It also reduces greed. This method incorporates an excellent money management methodology. Okay, it allows room for small drawdown. If you follow everything as taught in this lesson, I'm very sure the element of greed will be destroyed. This method is a greed killer, and for you to do well in trading, you have to be in control. Once you are in control, the fear and greed will be destroyed. And how can you be in control if the system is not good? If the system won't tell you when to go in and cash out? This system will ultimately encourage you to be in control. In every business, you must be in control, and there you must also use the power of leverage and control. The power of leverage and control is incorporated into the system that makes it a formidable and reliable trading method. The method explained. This method tends to determine strength and weakness of a trend at higher time frame using several convergences, several technical reasons. Okay, so once in a daily time frame, we've seen a weakness or a strength. Then we come down to lower time frame to trade the weaknesses or strength as trend reversal. This is top to bottom down analysis or multi-time frame analysis. It incorporates the fusion of the daily time frame and the lower time frame to give us a buying and selling opportunities. We understand that the daily time frame controls the lower time frame, and if we understand what is happening on the daily time frame and using that pre-informed knowledge to trade on the lower time frame, most likely we will be right in our trades. And trading, we want to trade when there is higher probability. Good traders always place themselves in a vantage position to execute higher probability trade, and this method will place you in that vantage position. For this method, we recommend that analysis be carried out on a broker whose server closes for the day at the same time that New York session closes, that is 5 p.m. Eastern Time. 5 p.m. Eastern Time. Okay, so in carrying out your analysis, we advise that you look for broker whose servers closes the same time as the New York session closes. Why? We understand that trading session starts pre-Asian session with the Wellington session, move into Frankfurt, Frankfurt to London, London to New York, and the New York session wrap up the old session. So we want to trade with a broker that runs the same time as this session to place us in a vantage position. So it is very important that you look for brokers that closes the same time as the New York session. It's not necessarily you place your live trade on these brokers. You can do your analysis on this broker's platform and place your live trade on your preferred broker. Now, how do we use this method to identify trading opportunity? How do we use it to identify trading opportunity? Now, in trading this method, we've earlier said that we look for certain criteria or conditions on higher time frame, that's the daily time frame, and come to lower time frame to execute the trade or identify the trading opportunity based on events on higher time frame. So the step one, the first thing we do is to scan for daily reversal formation on daily time frame. Scan for DRF on daily time frame. Now in this section, I'm going to explain our thought process in identifying and executing possible short trades, possible bearish trades, possible sell opportunity across currencies. So on the daily time frame, when the daily candle closes, we scan the currencies for bearish DRF. Now looking at the chart, we have a bearish DRF as indicated by the arrow. A bearish DRF from the last previous lesson has a higher high and a lower low. It has a higher high and a lower low compared to the previous candle. Now we've identified a DRF. The next thing we want to do is we want to determine if does it worth trading. You have to determine, can I put in my money into this trade? You have to determine if it's worth trading. We're not going to trade every DRF. We're going to filter the good ones from the bad ones. And the technical knowledge acquired from our previous lesson will be able to tell us how to filter the good ones from the bad ones. So you can see how previous lessons, they are helping us to identify good trading opportunity. So if you are not taking the previous lesson seriously, I'll advise you do that. because you're going to use everything that you've learned in the previous lesson to identify and execute a trade. That's wonderful. That's the power of synergy. We are putting everything together to look for trades. Identify high probability trade. We are only interested in locating high probability trade. From the chart on the left, we have the following technical reasons to support our claim for price weakness. Number one, trendline rejection, which supports bearish move. Now looking at the chart, everything below the trend line, it's in sell zone, and everything above the trend line, it's in buy zone. So we are executing a sell opportunity. We are identifying a sell opportunity in a sell zone, and that is safe, isn't it? It's not safe to look for a bearish trade opportunity in a buy zone. That is dangerous. We're not going to look for low probability trade. We are here to teach you how to identify high probability trade. So selling in a sell zone, it's safe. It's safe and it's a high probability trade. Quite wonderful. I'm so excited about all these things that we've learned in the previous lesson is taking shape and giving us direction on how to identify good trading opportunity. That is awesome, excellent. DRF is formed at Q level. Technical reason 2. DRF is formed at Q level. The DRF signifies a possible weakness in bullish move. Now, when we are seeing this possible weakness in bullish move around a key level at the top of a trend, and that means the trend is facing a barrier. There is a resistance resisting price from moving further up. That is wonderful. So that means something is resisting price from going up in a sell zone. Good. Amazing. Good. Excellent. That is what I call high probability trade, and that is what you should always look for when you want to trade. Trading, identifying, locating high probability opportunity in the currency market will save you the stress of losing out your capital. Our number one philosophy in integrated FX solution is capital preservation. 3. The DRF is formed at RT of a bearish king's crown. Is formed at the right tip of a bearish king's crown. So that means on a daily time frame, we are experiencing a change in trend from bullish to bearish. So we are selling in a sell zone at a key level at the point that the trend is turning from bullish to bearish. This is 100% trade. This is the kind of trade we should look for. On the 4th of November 2010, the candle closed bearish DRF with several technical reasons as stated above to support a speculated bearish move. On 1 hour time frame, this is what we are saying. price is moving from left to right, and that is bullish trend. The daily says look for bearish trend, so we are going to wait for the time that price will be changing from bullish to bearish. We are going to place ourselves at position when the trend will be changing even on the lower time frame. Trend analysis on 1 hour time frame. Looking at 1 hour time frame, we can see that price is making higher high and higher low. Once price is making higher high and higher low, means price is appreciating. So what we need to do is to watch price action, the trend analysis. We have to analyze the trend until the point that price is changing from bullish to bearish. Trend analysis on 1 hour time frame. Now we can see something strange is happening here. Now price dip from the indecision candle down, taking out the support, that is price moving below the support, and that is what we call bearish impulsive wave. When price moved down below the last support in a higher high and higher low sequence, thereby violating that sequence, creating a bearish AB, and that is what we call bearish impulsive wave, the beginning of a dip that we are about to experience, the beginning of bearish move, massive bearish move that we are about to experience. So we have a bearish AB in a swing AB. So what we are doing now is, we know that price moves in A, B, C, D pattern. A, B, C, D pattern. And from the previous lesson, the best place to initiate a sell or buy opportunity is at C. So price has created a bearish AB. We're expecting price to retrace within that AB to create a C and move down to D. And that is what price keeps doing every now and then. Pull up your chart and see this. That's what price does. And that is how the pro trades. So once we are able to identify the bearish impulsive wave, the next thing to do is to spread our Fibonacci. So with our Fibonacci, we should be able to know the expected retracement point. That is the work and the power of Fibonacci. Okay, we need to compute the following figures from the chart to execute the trade plan, and this includes the stop loss, the entry price, the risk, target 1 and target. So we spread the fib, okay, and the next thing is to compute the following values. Stop loss. What is stop loss? Now stop loss is a price value that is given to the broker, that in case price should go against us, once it gets to that level, the trade be closed with small profits, rather than exposing our capital to the big risk of losing everything and start crying like a baby. We don't want to do that. We don't want to cry like baby. We want to be in control. Every successful trader is always in control. The entry price is the price given to the broker to execute a sell on behalf of his client. An instruction given to the broker to execute a sell when price gets to that level on its client's behalf. Target 1 and target 2 is like take profit level. Once price moves in our direction and it gets to this level, the broker closes the trade in profit. So once we spread the fib, it's very important we note 1. The price of 61.8 Fibonacci level and the beginning of the dip. Looking at the chart, the dip started from 0.8817 and the 61.8 Fibonacci level is at 0.8778. These two numbers must be written down because they will be used to compute other values in stop loss, target, risk, and target 2. Formulas for entry: stop, risk, take profit 1 and 2. Now in everything we have formula, almost everything formula. For everything, simple interest have formula. To calculate simple interest on investment, there is formula. If you remember vividly, simple interest is principal multiplied by rate multiplied by time over 100. The principal is the capital, the rate is the interest rate given, the time is the duration of investment. So we also have formulas for our entries as stop loss, risk, target 1 and target 2. That's simple. Simple arithmetic. Everything that we've learned will be put in place to determine when to buy or sell. Now the start, the beginning of the rally of the dip is at 0.8817. The fib at 0.8778. Buffer is 3. What is buffer? Buffer is an arbitrary number given. We have seen over and over again that at times price wouldn't get to the 61.8 level exactly before turning, and because we don't want to miss out in a trade, we are able to allow 3 pips to create room for these disparities. And over the years across currencies, we've seen that 3 is effective enough to accommodate that. So we have buffer as 3. Our entry level, what is entry level? Entry is equal to 61.8 Fibonacci level minus buffer. What is our entry? What is our Fibonacci level? Is 0.8878 minus 3. Now, because price is in 4 decimal places, that buffer is the same thing as 0.0003. And once that is subtracted from the 61.8 Fibonacci price level, we have 0.8775. What is the formula for stop loss? Stop loss equals to start plus spread plus 10. Remember from lesson 1, spread is the difference between the buying price and the sell price, bid and ask price. So for the currency in question, Euro GBP, the spread is 4, so stop loss is 0.8817 plus 10 plus 4, and that gives 0.8831. What is the formula for risk? Risk is equal to stop loss minus entry price. The stop loss as derived is 0.8831. Entry price is 0.8775. The risk is 56, and that is same thing as 0.0056. What is the formula for target 1? Take profit 1. Target 1 equals to entry minus risk, and that gives 0.8775 minus 56, and the answer is 0.8719. Target 2. How do we arrive at target 2? From Fibonacci theorem. When price retraces to 61.8, we expect price to extend to 1.618 to form D and a complete wave circle. Amazing discovery by Fibonacci. Amazing discovery. Wow, I'm excited. We are making use of everything that has been taught. This is application of knowledge. There is a popular adage which says that knowledge is power. No, knowledge is potential power. Applied knowledge is power. Wow, amazing. And target 2 is 0.8654. These are entry placed on the 14th or on the 4th of November 2010 at 22:30 GMT. The stop loss is given, the entry price is given, the target 1 and target 2 all given at 22:30 GMT on the 4th of November 2010. On the 5th of November 2010 at exactly 10:15 a.m. price retraced as expected to our expected level, and once price retraced to that point, the broker have no option than to honor our instruction, and that is what we call price was triggered. Entry price was triggered, was honored at that time. Boom! Our targets have filled the same day. Wonderful. Wow. In 1, 2, 3, 4, 5, 6, 7, 8. In 8 candles, which represent 8 hours, our target 1 and target 2 were filled, and we had a rise, a swell in capital. We made profit. We are in business to make profit, and that is what IFS stands to teach people. We are creating wealth, also empowering people. We want to teach you how to fish, and that is what Integrated FS Solutions stands for. In summary, let's look at what we did in summary. The first thing we have to do is to look for bearish DRF. Now, the bearish DRF would determine the trading position we are taking, that is short, we are selling. Once we see the bearish DRF, we want to determine if it's a good one. Okay, and how do we determine if it's a good one? It's using our technical knowledge. And once we've done that, then we are confident that the trade is good. The most important thing is the step 2. Our analysis must be thorough. We must not initiate any position in an unfriendly zone. We should always look for safe zone. Again, look for safe zone. Once the daily time frame is giving us a nod in a bearish direction, so we go to 1 hour time frame and look for bearish reversal crown formation, and that's what we do every now and then in placing sell position. We've gone through the thought process of initiating a sell position. So how do we buy? How does our trading method, how does our hedge gives us a buy position? Now, this the same thought process but in an opposite. We do virtually almost the same thing every now and then. Step 1. Scan for bullish daily reversal formation on daily time frame when the daily candle closes. Bullish DRF have lower low and higher close compared to the previous candle. Now we've seen a bullish DRF. What's the next thing? We should be able to determine if it's a good trade to place. And how do we do that? We use our technical knowledge to be able to determine if it is tradable or not. From the chart on the left, we have the following technical reasons to support our claim for price strength. 1. Trendline rejection as support. Remember, everything above the trend line is buy. So we are looking for buy opportunity in a buy zone, and that is a safe trade. It's a safe zone. Don't look for trade in an unfriendly zone or zone that is not safe. Always look for buy opportunity, sell opportunity in a safe zone. So buying in a buy zone is a safe zone. 2. The trend line. The DRF is also formed at key level. When key level is found at the bottom of a trend, it will serve as a very strong support that will reject price. So what are we having here? We are having two strong supports that will reject price and make price to turn from bearish to bullish in a safe zone. That's amazing, isn't it? It's quite amazing. All these technical confluences support our buyers for a bullish run till next resistance level at 1.4. Step 3. Narrow down to 1 hour time frame to look for possible bullish trade. On 1 hour time frame, we can see a nice bearish move. On the 15th of November at 22 GMT, here is what the chart looked like. So we can see that the trend on 1 hour time frame is bearish. We have to position ourselves at a vantage place to identify possible bullish trend change. Now looking at the 1 hour time frame, once again, price was making lower low and lower high, but all of a sudden price rallied above the last resistance, the higher low, rallied above it, creating a bullish impulsive wave. Creating what? A bullish impulsive wave, thereby violating the lower low and lower high, creating a bullish swing AB. At this point, we'll be anticipating a retracement back to C before moving to form D. Once we've identified the bullish impulsive wave, we'll spread our fib. Once the fib is spread, we'll now wait for price to retrace to our expected level, and our expected level is 61.8. If you remember from the Fibonacci lesson we had, the 61.8 is known as the golden ratio, and the golden ratio has found expression in the things of the nature, galaxies, architectural design, and also if you look at a perfect or beautiful face, you will see golden ratio finding expression. At the same time, the golden ratio is finding expression in the currency market. So we'll spread the fib as shown on the chart. So once the fib is spread, the next thing we have to do is to locate the price value of 61.8 and the beginning of the rally. These prices will be used to compute risk, stop loss, target 1 and target 2. So the fib is spread as indicated on the chart. Formula for entry, stop, risk, take profit 1 and 2. So we have the value of start, 61.8 fib and buffer. Entry, the formula for entry is 61.8 fib level, the price plus buffer, and that gives 1.3741 plus 3, which is 1.3744. That gives our entry price. Entry price is 1.3744. Stop loss is start minus 10. Stop loss is start minus 10, and that gives 1.3645. Risk equals entry price minus stop loss, and that gives 100 pips. Target 1 is entry plus risk, and that gives 1.3844. Target 2 is our expected extension level at 1.618. So in summary, we have entry at 1.3744, stop loss at 1.3645, target 1 at 1.3844, target 2 at 1.4018. On the 15th of November 2010 at 11 p.m., trade orders were placed based on the information given on the chart. We have stop loss, entry, target 1 and target 2. This will be given as an instruction to the broker to execute the trade on its client's behalf. The following day, our entry was triggered at 15 GMT. The entry was triggered at 15 GMT. So you don't need to panic even when your entry is not triggered earlier. You need not to panic. Now, something has happened. Like we said in the previous section, that once in a while the market dynamics changes. This market is dynamic, okay? and then once in a while there's a little bit change according to the initial plan. Once we notice or observe that change, we also need to change to accommodate the change as discovered. Now 61.8 was the expected retracement level, but price gave a deep retracement. The price went as deep as 78.6 level before it starts climbing up. And according to our Fibonacci law, once price retraced till 78.6 level, the expected extension level is at 1.27. So our target 2 needs to be adjusted to accommodate that change. Our initial target 2 was at 1.4017, and that needs to be adjusted to 1.3941, which is the 1.27 Fibonacci extension. Wow, this was a very long time for the targets to be filled. It took a very long time. Target 1 was filled exactly after 24 hours when the entry was filled. Target 1 was filled and target 2 was filled 72 hours later. Could be that long sometimes, and that's why it's called swing trades. Trades are expected to last for few hours and at times few days. What we did in summary: once price forms a bullish DRF on daily time frame, the formation informs us of possible strength in a prevailing trend, and if the formation has several confluences to support this possible strength, then the trend stands high chance of either retracement or reversal. Trade will be initiated on 1 hour time frame using bullish crown formation to trade the reversal. We have bullish DRF on daily time frame, and once we can establish that it's a very good one, we come to lower time frame to look for bullish crown, top to bottom approach, and that's top to bottom approach, and that's what we use to execute our trade. Traders, if you can thoroughly follow the instruction given on this lesson, I tell you, you will only experience success. Once again, success and nothing but success.